Jason, it's great to have you here on a day like this and at a time like this when everyone assumes because of the severity of the Ukraine crisis, the Fed's going to have to back off. But this data to me suggests that they might have to press forward. What do you think?
Yeah, the U.S. economy has an extraordinary amount of momentum. Adding nearly 600,000 jobs per month, month in and month out, no matter what's going on. Jay Powell said they're going to raise rates by a quarter point at their March meeting, and this virtually guarantees that. Yeah,
it guarantees a quarter point hike, but what about their just real world reaction to unpredictable events like the Ukrainian crisis? Why can't they just afford to sit back and go, you know what, we're just going to wait a little while, see how that one turns out before we press ahead with this tightening?
Look, the last time we had a financial crisis in Russia was 25 years ago. The Fed ended up cutting rates by 75 basis points to deal with long-term capital management and the fallout of that Russian debt crisis. Nothing like that's going to happen this time, but it may give them a little bit of pause on the path they'd otherwise be. We'll see. By May, by June, if the uncertainty associated with Ukraine is down, if inflation remains hot, which I expect it to be, we might start seeing some half-point hikes at some meetings this year, but they don't need to decide that now.
Sure, but would you basically say they are undeniably behind the curve here? I mean, it's incredible how strong the jobs market is. You remember this. You go back and look at the recoveries after the last couple of recessions. We rarely ever had a print like what we saw this month, let alone 10 straight months of prints over 400,000, let alone this late into the labor market's recovery.
Look, there's no doubt they were behind the curve. They've been catching up quickly. They understand that the problem our economy faces is about inflation right now, not about employment right now. And the most important thing is that they're telegraphing that steady path, hopefully telegraphing that every meeting they're going to be raising rates until inflation gets much better under control than it has been.
Yeah, so let's talk about wages, which, again, we saw them basically flat in February from January. They're still at 5.1% year on year. Is it your expectation that that's going to drop below 4% anytime soon? And what do you think is the key level to watch there?
Yeah, I thought inflation was wages was the big news. If I was looking at it from the perspective of the Fed, I would actually had that more in the good category than you did. We already knew we had high wage growth for most of the months last year that are in the 12-month number. The big news was there was basically no growth that happened in the month of February. I think that's an aberration. This thing bounces around from month to month. I expect wages around 5.5% or 6% growth this year.
Wow.
If we get that, that's consistent with inflation of around 4% this year. But, maybe it'll be lower than that. Certainly employers, if you ask them, they aren't planning to raise wages by as much as I just said.
Yeah, you can't put it in the good camp if you still think we could be seeing wages that high this year, right? Like that means that it's not enough to call it a trend.
Oh, just to be clear, February, if you had asked me yesterday, I would have said 6% wage growth this year. After I saw the February number, I'm now down to 5.8% wage growth for this year. So a little bit less inflation than I might have thought coming out of this report, but only a little bit.
Shepard Smith here. Thanks for watching CNBC on YouTube.